topics. We will look at the stock market, whether the stock market will correct, or could we have a certain crash, or could the stock market continuously go higher. We will look at precious metals in great detail, AI, portfolio structure in the current environment, and many other very interesting topics. So Jim, thank you so much for being here.
Thank you, Vlaslav. Great to be with you.
It's a pleasure to have you on the show, Jim. So if we could start with the big topic. So of course, the stock markets. And some people believe that, well, stock markets are overvalued. The valuations need to correct. But then some people believe, Jim, that because the Fed always has their back, they will print the currency and everything will be good, happiness and joy ahead. And I know, Jim, that you look at things from a complexity theory, and you pay particular attention to velocity of money, which is pretty much how often money changes hands. So if we could talk about that, but keeping in mind the stock market.
Sure, I'd be glad to. Let's start with the stock market. That's the big picture. That's where, for better or worse, most people have most of their assets. So actually, everyday Americans, at least, maybe people around the world, have a lot of their assets in their home, their real estate. But in terms of investable assets, the stock market's probably number one. So I don't think of stock markets as being right or wrong. I just say they are what they are. It's important to understand them and know the history and think about what could come next. But you don't fight them. You don't get upset about it. You just kind of analyze it. There's very little doubt that the stock market's in a bubble. I think that's crystal clear. And the Federal Reserve, going back to Alan Greenspan, but others, Bernanke and Yellen, they sort of took the attitude that, well, we're the Fed. We don't know if it's a bubble or not. It's going up a lot. Is that a bubble or is that solid fundamentals? Is that the way things are supposed to go? We can't tell. So we're going to keep out of it. But if it crashes, we'll come in and clean up the mess. Like a janitor crew in a supermarket. you clean up the spilled milk. That's what the Fed says. That's what they do, and they're completely wrong as usual because the Fed's wrong about most things. But there's nothing easier to see than a bubble. You can spot it a mile away. Just look at a chart. And I'm not a technical analyst, but I do look at charts, and I get they do have good informational content. Look at the Nikkei index in 1989. Look at the Nasdaq index in 1999. Look at other indices at various times. You can see the bubble. Actually, look at the U.S. stock market today. You can see the bubble. Now, that's the easy part. The hard part is, when is it going to break? When is it going to crash? That is very, very difficult. So when the stock market's going up the way it has been recently, I don't tell people, hey, why don't you just go buy puts on the S&P 500 index? Why don't you just short the market? I don't recommend that because it could go up more. I mean, in other words, just because it's in a bubble doesn't mean the bubble won't get bigger. And if you're short, you could lose a lot. You can lose money. Basically, I say you can lose money being right. You can be right about the bubble, but you can lose money if you short it and it's still going up. So what do you do? Well, what you can do when you see this is lighten up your allocation. Just don't be 80, 70, 80, 90% in stocks. Lighten it up. You don't have to get out of the stock market completely, but lighten up to maybe something more like, I'll say 30% or so. And then diversify your portfolio. When I talk about diversification, people roll their eyes. They go, "Oh, Jim, everyone knows diversification. What's the big deal?" They actually don't, because I run into people all the time and they say, "Well, I'm highly diversified. I've got 50 stocks in 10 different sectors. I've got telecommunications, semiconductors, minerals and mining, et cetera." I say, "Well, you're not diversified. You may have 50 stocks in 10 sectors, but you have one asset class, which is stocks. When they go down, they're all going to go down together. Not all of them, but almost all of them. So you're actually not diversified, even though your wealth manager is probably telling you you are." Real diversification will be, slice of stocks. Gold, I recommend 10%. Treasury notes, interest rates are going to come down a lot when this thing breaks. They may go up a little bit in the short run, but they're going to come down a lot in the intermediate run, so you have large capital gains there. Big slug of cash, maybe 30%. People go, well, cash doesn't have much yield. Well, it has more than it did a couple of years ago, but the point is it has embedded optionality. When you have cash, in effect, that's a call option, at the money call option on every asset class in the world. When things crash, you're the one who can go shopping. Everyone else would be like selling things, fire sale, trying to get some cash or preserve wealth. You'll be the one who can go out and buy the bargains. Real estate, I don't recommend commercial real estate at this stage, but income-producing real estate, farms, housing, yes, always good area, good quality, but that'll serve you well. So gold, and then for the stock market, if you have some stocks, I like defense. Obviously, that's going to go up. Healthcare, just because of demographics, and natural resources, oil, agricultural companies, Cargill and so forth. So defense, oil, natural resources, and healthcare are all, minerals and mining. Those are all good sectors. For just speaking for myself, I'd get the heck out of AI and hyperscalers and all that. And just to be clear, AI is not going to go away. It's powerful. I get it. I wrote a book about it, Money GPT. It's here to stay. But that doesn't mean that every single hyperscaler, every single semiconductor manufacturer, et cetera, is going to survive. Some of them are just way, way over indebted. It's kind of like the railroads. I mean, we built a transcontinental railroad in 1869. The railroad boom lasted throughout the entire second half of the 19th century, and it was very, very successful. But a lot of railroad bondholders went bankrupt because the railroads went bankrupt, particular railroads did. So the sector can be fine in terms of technology and being around, but the stocks can still go to zero. So that's really, I'm not saying this is the end of AI, but it might very well be the end of some of these big AI companies, or at least, they don't have to go to zero, but if the valuations go down 30, 50%, that's not a lot of fun. So I would be definitely out of those sectors, even though I think, again, the technology is going to be around. So the short answer is stocks are in a bubble, very clear. Don't know when it's going to break. It will, but not necessarily tomorrow or next week. When it does, if you've got gold, cash, real estate, treasuries, and you've lightened up on equities and diversified your portfolio, you'll do fine. If you're 70, 80, 90% in what they call the Magnificent Seven, or some of these companies aren't even public yet, Anthropic and OpenAI are working on their IPOs, but if you're in that, then you may take a beating.
Yes, and the reason I mentioned velocity of money, Jim, is because many people believe that if the stock market, if we have this crash, the Fed will come in, they will print tons of money, and that money will go to the wealthy, they own the means of production, and they will have to invest that money, and markets will go much higher. And so, from what I understand, you don't necessarily agree with that.
That's right. I mean, everything you said is the narrative, and that is what people believe, but it's all wrong. But let me explain why. I don't like to say things like that without giving an explanation. First of all, right now there's a global dollar shortage. And people go, wait a second, the Fed has printed, tens of trillions of dollars. How could there be a dollar shortage? Well, you have to understand how monetary policy actually works, what I call the plumbing. So how does the Fed does print money, there's no question about that, but what kind of money? And how does the Fed print the money? Well, the way they do it, they have an open market desk at the Federal Reserve Bank of New York, and they deal with certain banks, and only certain ones. There's a list. The names on the list are called the primary dealers. But that's not even a license, it's a relationship. But if you're a primary dealer, what it means is that you can act as a dealer to the Fed. When they want to buy or sell securities, they call you. There are only about 20 names on the list. It's not like 200 banks or whatever. I was on the executive committee of one of the primary dealers for over a decade. I talked to the Fed every day. At that time. But what it means is that when the open market desk at the Federal Reserve Bank of New York wants to buy or sell securities, they call your firm or one of these other firms. So what do? So when they want to print money, basically expand the money supply, and when we say money supply, we're talking about M0. I always point out there's M0, M1, M2. The Fed doesn't even know what money is because they've got vanilla, chocolate, and strawberry. They got 3 flavors, so they're not even quite sure. But what the Fed prints is M0, so-called